Welcome to the third episode of Options Blackboard. My name is Adam Lass. Greetings to my first-timers, and for those of you who watched episode 2, welcome back. As quick background about myself, currently I serve as editor for Wave Strength Options Weekly, an options trading service based on history, economics, value, and technical analysis. I also serve as a regular contributor to Taipan Daily with our editorial director, Justice Lytle. Now, I've been trading and writing about stocks and options for more than a decade. But before that, I was a regular business guy, just like so many of you. In episode 2, we looked into what a call option contract was and how it allowed you to magnify the gains a rising stock makes while committing a much smaller amount of your capital. But stocks don't always go up now, do they? As so many investors have learned over the past few years, the stock market is a two-way street. That's bad for two important reasons. The first is obvious. Investors lose money when shares go down. The second is less obvious, but perhaps a bit more important. If the only way you can make money is when a stock goes up, you can become biased, constantly searching for reasons to believe that things are all good and blind to the dangers that may be lurking just around the corner. The true beauty of put option contracts is that they can protect you from both problems. First of all, you can use them to protect your stock portfolio. That's exactly what a lot of the major stock fund managers do each and every day. Second, they allow you to make a dandy profit in a falling stock market just as easily as a rising one. So, instead of always searching for reasons to trust Wall Street, you can look at the market with clear eyes and a clear mind. Just as we did with calls, let's map out exactly how a put option contract works, when you should buy one, when you should sell one, and the special codes you need to tell your broker what to do. Let's take another look at what's going on with our made-up company, Jackson Widgets, again. Since we made them up, we can make up a brewing disaster for them, too. You've got 100 shares that are hanging out around $10 again. But now we see indications of a collapse coming. Need a reason? Let's say they're about to lose a big contract to a rival. We can use a variety of means to predict the extent of the coming drop. Value analysis might look at how the loss of this contract will alter the company's bottom line. Technical analysis looks for attractive nodes and support points based on previous share price behavior. Regardless of your preference, and I actually use both in my work, we're going to slate JW for a drop to $7.50 a share. Your tactic now would be to buy a put option contract. And once again, you have a myriad of choices. As I said in episode 1, buying a put gives you the right, but not the obligation, to put 100 shares of stock to the market for a certain price before a certain date. And as with calls, that certain price is called the strike price, and that date is the expiration date. You can see option prices for free at Yahoo Finance if you don't mind a 20-minute delay. Most decent brokers offer a pretty good real-time ticker once you get an account. Now, since JW stock is at about $10, let's only look at put options with strike prices of $10. This is called, once again, at the money. If you exercise the contracts right now, you could sell shares for the same price that they are currently trading at. Therefore, this contract has no extra intrinsic value. Now let's look at dates. Once again, it takes time to make money, so contract time costs money. You want enough time for bad things to happen to the underlying stock. Well, the guys at the exchange know this and are going to charge accordingly. At WOW, we figure that contract time is worth paying about $1 a month as a rule of thumb. Let's say you figure to hold this option for about 3 months. As I sit to write, it's August, so you would want to buy a contract dated November 2009. So the contract you are looking for will be labeled something like this: Jackson Widgets, November 10 put, JWXXY. Jackson Widgets is the underlying asset, November is the expiration date, 10 is the strike price, and it's a put contract. Those last 5 letters in the brackets are the special identifying code you will need to place the order with your broker. Now remember, you can't invest in Jackson Widgets. We made this company up, so you don't need to jot down these particular codes. Remember that peculiar jargon thing I warned you about in episodes 1 and 2? Well, all stock option contracts are priced as if they only dealt in one share of stock. But in reality, all stock option contracts control 100 shares of stock. Now let's go back to the trade. With JW trading at $10, this $10 strike contract has no excess intrinsic value to pay for. It is dated November, so it will expire on November 18th. So you will need to sell it or exercise it any time before that date. That's 3 months of time, so you can expect to pay $3 per share, give or take a nickel, if you bought in August. Just like stocks, option contracts generally have a lower bid. The price the guys on the trading floor will pay you if you are selling, and a slightly higher ask, the price they are charging if you want to buy. The asking price for our Jackson Widgets November 2009-10 put, JWXXY, is listed at $3.20. That means it will cost you $320, and you now control the fate of $1,000 worth of stock for the next 3 months. Remember how I told you about Delta in the last session? The at-the-money put options we are looking at today are carrying a delta of 0.70. That means you can expect the option to go up 70 cents for every $1 the stock falls, times 100. Now Jackson confesses that it has indeed lost that big contract. Shares drop as predicted from $10 to $7.50. Investors have lost 25%. Folks who went to cash lost nothing, but they didn't make anything either. But your put option contracts have gone up 70 cents times $2.50 times 100 shares. That's $175 in profits on an investment of $320 for a gain of roughly 55% when most everyone else was losing their shirts. Nifty, huh? But wait, it can get even better. Let's say JW gets in real trouble. We know this can happen. Heck, we've seen companies get cut in half with fair regularity lately. If JW drops from $10 to $5, your put contracts gain more than 109%. That's right, you can easily double your money when everyone else is getting cut in half. And just to show you what can happen, if JW goes to $2.50 a share, in the last crash, we saw this happen to dozens of major blue chip players. You could see gains of over 164%. Now, once again, if you are willing to learn a few simple buzzwords and master some pretty straightforward arithmetic, you can totally change how you look at the markets. Suddenly, you don't have to dread downside because it can offer you the exact same opportunity for gains that upside does. And now, you can invest just as happily in crashing markets as rising ones. In the next episode, I'll explain why the other guy sells you options in the first place. To do that, I'll give you a little bit of history, lance a big myth, and show you why options are not just a big casino, but rather a crucial part of the modern stock market. Oh, and did I mention the part where you just might get cash money for doing absolutely nothing? Until then, send additional comments to adam@taipandaily.com. And thanks again for joining me, Adam Lass, in the third episode of Taipan Daily Publishing Group's Options Blackboard.